Today, we're thrilled to have longtime collaborator and greatly valued partner, Jeremy Halpern, here to discuss using convertible debt and SAFEs to bridge through this crisis. It's a critical topic, as you know, you're all, I'm sure, looking at managing your own cash flow and looking at financing options for your work during this time. So we thank you, Jeremy, for tackling this topic for us and for the community. Jeremy's a partner at Nutter, where he serves as the firm's co-chair of the Emerging Companies Group and co-chair of the Food and Beverage team. We're thrilled to have you, Jeremy. As I said, thank you again for doing this, and the floor is yours.
Okay, thank you, Lauren. Can you guys all hear me okay? Can I get a sound check, Lauren? All right, excellent. So thanks everyone for coming. I know we have a mix of folks on the phone, some folks who are newer to the world of food and beverage, some folks who are at the very early stage of their ventures development, and some others who are much more sophisticated. So I'm gonna try and aim to the middle. If you have questions during the presentation, how do you want to do it, Lauren? Are we going to have people raise digital hands, or are they going to send you, chat questions? What's the best process?
Yep. So over the course of the conversation, if folks have questions, feel free to submit them to me through the chat. Otherwise, at the end of the presentation, which will run about 40-45 minutes, we'll switch to Q&A, and you can unmute yourself at that time to ask the question yourself. But if you're in a noisy environment, feel free to send it to me, and I'm happy to relay it to Jeremy.
Awesome, thank you. So we're going to get started. I'm going to give you the 30-second infomercial on Nutter, and just to give you a little bit of background on the firm, and then a tiny bit of info on me, and then we'll jump right into it, because I know you all have a bunch of questions on this topic. So thank you, everyone. I hope everyone is well and safe, or if you're among the plague-ridden, that you are recovering well. Thank you for being here today. So we wanted to talk about convertible notes and SAFEs. And by background, I come at this as a lawyer from a very large law firm, and we support businesses through pretty much the range of things that if you were a food and beverage brand, if you were a food and beverage retailer or distributor or broker or investor, we pretty much do just about everything that you would need other than regulatory support, where we partner with some folks outside the firm. But we do a lot of work in corporate, a lot of work in financing, in commercial agreements, IP, exits. And we do that for some of the smaller brands who you may know. Some of these are local, some of them are not. And we do it for, for others that have reached more national scale and are shipping across the country. They're, 3,000, 5,000 doors. Some of them are 10,000 doors, bigger brands. And we do that all the way up to some very, very mature brands. We do a tremendous amount of work for folks like Cedars and Catania and JH, long-standing, very mature brands, profitable businesses, not looking for exit kind of businesses in many cases. And we also do some stuff in the technology, right, in the retail space. So if this applies to you, and you have questions after this program, please feel free to reach out. Lauren will post my information in the chat window, and please do feel free to just send me an email or connect on LinkedIn, or arrange a time to talk. Normally I'd be happy to have coffee, but for the moment I think we're on digital coffee, so we'll make it work. It's a big team. We have about 23 people doing a tremendous amount of work in food and beverage throughout the firm, so across a range of disciplines. So most of your questions are things that we can help with. Just by background for me, I'm a little unusual. I do come at this as a corporate lawyer and helping people think about this, but I've actually spent time in my career as an entrepreneur. I am an active angel investor. I've been part of a venture group, and I've been an entrepreneur. I've been out there asking people for money. So I have a little bit of an unusual perspective on it. So what are we talking about today? Oops, sorry, too fast on the clicks. We're talking about using debt and SAFEs to bridge through crisis. And so in order to get us through that, again, not knowing everyone's respective level of expertise in this stuff, what I thought I'd do is just go back through what is convertible debt, what is a SAFE, how do they work, then talk a little bit about how the crisis currently is affecting some of those things, and some things to watch out for, some things that you don't often see coming in the story. And for this presentation, anytime we say convertible debt, we also make convertible notes, exactly same thing. The note is the thing you get that represents the debt, but those are synonymous terms. And a SAFE we'll talk about more. For those who don't know what they are, we'll get into them a little later in the presentation, but that stands for Simple Agreement for Future Equity. And we'll talk about what that means in a bit. So how do notes work? Just to remind everybody, I, the investor, give you, the entrepreneur, some cash, and it's for an indeterminate amount of equity. We don't know how much equity it's going to turn into. It says it will convert at some price in some mechanism somewhere down the line, depending upon what happened. And the design of it, I don't know if you all can see my cursor, but the design of it is this is supposed to be a bridge, not a pier. This is supposed to get us from today's moment, where we have a certain set of facts, to a next different moment. What do I mean by that? Right now, the company, all of your companies are a collection of hypotheses and some amount of data. And those hypotheses and data represent both opportunity and they represent risk. And every day you operate, you're trying to, we often call them valuation milestones. You're trying to increase the value of the company. And you do that by starting to prove whether those hypotheses are true. And if they're not true, learning from them and having a new hypothesis that is data supported. And what does that mean? It means that you have properly identified a market opportunity. And in our world, in food and beverage and in brands, we typically think of that as a consumer need state that's being unfulfilled. You've identified how to build a product to fulfill that opportunity, and you've done so at a cost structure and in a supply chain that is scalable. And you can figure out not only how to build a product at a reasonable gross margin, but you can get it to the customer. You can figure out how to get that customer's attention, and you can get them to become brand loyal and net promoters of your product. They become brand advocates for you, and they're repeat buyers, so that your cost of their next purchase, the cost of acquiring that next purchase, goes down. That's the beauty of the scalability and the customer loyalty. And at the beginning, as I said, you don't know any of those are true, right? You just have a thesis, and those first few years of operating are all about proving whether those things are true. And so sometimes when you show up to an investor and you ask for money, the answer is that so many things are unknown that the investor says, well, on a risk-adjusted basis, I can't give you a high value because right now, everything is a collection of I don't knows. So I can give you some money now, and we can agree we'll price it later when we know a little bit more. And early stage investors, historically, what they did was they relied on the idea that in the future, we would know more and somebody could more accurately price the deal. Right? And so in exchange for that, because I'm taking more risk when I, the note investor, put money in today, I'm going to get a better deal than that future investor. But at the same time, I'm going to rely on their expertise as a more institutional investor or an investor with more information about the company to better articulate what is the correct map between what we actually have and what the price I'm paying is. And in theory, by not pricing it today when everything is unknown, it allows the company to build value before the equity investment is priced. And that allows you to reduce dilution. And just to remind everybody, dilution is the process by which, as new investors show up at the table and put cash into the business in exchange for shares, and it doesn't matter whether it's shares or membership units in an LLC, makes no difference, that the denominator is getting bigger. The number of total shares out there is getting bigger. So my proportion of shares, my number of shares may stay constant. I have, just for sake of argument, let's say I'm the entrepreneur and I have 1 million shares. Nothing happens to my 1 million shares, but when I start, I'm 1 million out of 1 million, I'm 100%. And over time, my million becomes 80%, 70%. That's the dilution. And so the rate at which that dilution is happening, for me, I would like that to be as little dilution as possible if I'm the entrepreneur. And so if I price the money too early at too unknown of a stage, I take a lot of dilution. So let me just use 2 stupid examples, but you'll get the idea, right? If I took in $1 million and my company was worth $2 million, I am selling 1/3 of the company, right? Because that 1 million represents 1 out of what is now a post money of 3 million. And I'm taking 1/3 dilution. The investor's getting 1/3. Whatever shares I have now represent now 2/3 after that deal. If I took it in at a $1 million valuation, the investor is getting 50%. So if the investor showed up and said, hey, I think your company's worth $1 million and I'm willing to put $1 million in, and you say, gee, 50% sounds like an awful lot of dilution. That doesn't sound good. I think my company's really worth $5 million. And the investor says, that's adorable, but no, your company is definitely not worth $5 million. And you can't agree, right? You can't agree. And so one of those things that we do with convertible notes is we bridge the gap. We say, I don't know, I think it's worth 5 million. You think it's worth 1 million. How do we compromise? Well, the answer is we agree on a note and we say, in 12 months, somebody will price this. I will get some value out of it by taking the earlier risk, but they'll price it. And then maybe it turns out it's worth 2 million. Maybe turns out it's worth 3 million. We'll see. We'll see in the future when we know more. So what are those key terms? Well, the key terms are those notes are bearing interest. So if investor is giving me $1 million, that interest coupon is usually from 5 to 10% simple interest. All of the interest is accruing but not paid currently. This is not like getting a bank loan where you're paying monthly amounts back. At least historically, the notes were typically unsecured, meaning they were just creditors in the ordinary course. You can't pay off the note without notifying the investor. And the note becomes due somewhere in the range of 12 to 24 months. And the idea is usually how long is the company going to take to spend the cash that's being raised? So if you're taking $1 million in, is it reasonable to assume that the company is going to go for 9 months on that million, 12 months, 18 months? What's happening? If the company is only raising 3 months of cash, it's often a big problem because, as you will see, what happens at the end. And the two big things that happen from a pricing perspective is that, number one, there's a discount. And that discount says, remember we said, I'm investing here, we're going to march along, and the new investor over here is going to pick a price, and I'm going to get something better than that. What's the better? The better is the discount. Traditionally in food and beverage, and in most even tech companies, the discount is somewhere between 5 and 20%. We often help people design things that are floating discounts. They're inclining, meaning the longer the period of time between point A, the note, and point B, the equity investment, the bigger the discount, because it represents that much more risk. If they put in the note and 90 days later you close the equity round, the answer is note investor didn't take a lot more risk. So maybe that's a 5% discount. If it took a year, maybe that's a 20% discount. Second, that interest is also converting in. We talked about the interest a minute ago. And the third is a cap. And the presence of caps is what changes a lot of the dynamics of this. Because a cap says, the investor says, I will pay 80% of, I'll get priced at 80% if we have a 20% discount, 80% of the next price, but in no event higher than X, X being the cap. So if you take nothing else away from this presentation, caps, good for investors, bad for stockholders. Okay. And there's an old joke about this, which is any deal that has a cap is stupid for owners to do, and any deal without a cap is stupid for investors to do. That doesn't leave you a lot of room to move, right? But the reality is who is taking the big risk. And so typically with a cap, the cap is the investor controlling the price at which they will ultimately invest. So having a cap these days is market. And that cap can either be simple. It can say, I'll get the better of 80% of next price or $3 million. Or the cap can be floating. The cap can say, I'll get the better of 80% of the next price, or particularly in food and beverage, using a last 12 months net revenue number, LTM. So it'll often say 3 times, 4 times LTM. That can be hugely dangerous for early stage brands, unless it is the higher of thing A or thing B, right? So you might say, hey, investor, we'll agree on a $3 million cap. Or if it turns out that we are crushing this, then your risk has really been reduced by the fact that we're being so successful. So you shouldn't care if it's the greater of 3 million or 4 times LTM, because if LTM turns out to be 2 million, you still have the 3 million protected player. If you do the lesser of those two things, it can be incredibly dilutive if the company does not perform. And then there are 4 things that can happen that would cause the conversion. Let's take the bottom 3 first, which is there's a sale event. We're in the middle of a process, 2 processes right now, where the companies have convertible notes that never got converted to equity and they're being bought out by an acquirer. So what do you do? And the usual rule is the investor gets the better of the conversion at some price, the default or maturity price, we'll talk about in a second, or often just a multiple of invested capital. And those tend to range between 1.25 and 2 times the principal and interest. Number 2, or the third bullet here, is the thing that everybody's actually trying to plan for, which is it automatically converts on a qualified financing. And a qualified financing is usually a preferred stock financing, typically with about 2 times the total quantity of cash as the notes represent. So if you're raising $500,000 in notes, you would expect to see a qualified financing around, the company goes and raises $1 million or more in a preferred stock financing. It would be weird if you said any financing, right? So if the company could go find some investor to put in $50,000, huge price, that would cause the conversion of the notes. The idea is the notes are a bridge to a well-priced investment from a sophisticated investor who has better information. And so you want that to be true. And then a non-qualified financing, so if you did find someone to put 50 grand into the company, usually the note investors have the right but not the obligation to convert. It's at their option. But then you get to a big issue, and this happened over the course from about 2008 to 2011. You started to see this happen a bit, which was the notes became due at maturity. And at maturity, if they are not automatically convertible, the company is obligated to repay the cash. I can't see your prospective hands at the moment, but if I could, and I said, how many of you think you will have that cash available to pay an investor at maturity? Probably none of your hands would go up, right? The company is burning capital. That is the burn rate. It is depleting cash on a very regular basis. So by the time that note is cycled through 12, 18 months, usually the company is again out of cash. It does not have the ability to pay. If you don't have the ability to pay a debt, as you know, that debt holder can foreclose on the company, cause a sale of the asset, and potentially grab the asset. They can own the company for the value of the debt unless you can find somebody to step into that very messy situation. So that became very scary for entrepreneurs. And the idea was, well, let's take the risk out of that. And let's make sure that at maturity, the note automatically converts, even if it converts at a lower price than it would have converted in that qualifying financing, because that at least makes sure that they can't snatch the asset for the value of the debt. So maybe the maturity conversion is a 2x LTM as opposed to a 4x LTM in a qualifying financing, right? The cap pricing. Or maybe it's just some number. We pick up, again, $2 million, because it's better off that you convert $500,000 in notes at a $2 million price than a $500,000 note at effectively a 0 price, which is what that foreclosure often can amount to. So how do notes, why do people use notes? Well, they're cheaper to document. They're very fast. You can just do note to you, note to you, note to you. You don't have to wrap everybody together, although there's some value to doing that. The transaction costs are lower for your lawyers. In theory, you don't need to agree on a valuation. As we said, it's the bridge between entrepreneur's point of view and investor's point of view. But you kind of do, because the cap pricing, the default pricing force you to make some of those same choices and have some of those same conversations. Notes historically had virtually no control rights. As more early stage investors have gotten into the game, we're starting to see notes that look a lot like equity from a control perspective, where people have side letters that say, I have a board seat, I have an observer seat, I have negative covenants, you're not allowed to do the following without my consent, I have preemptive rights, I have information rights, all kinds of things. So these note deals that you might have gotten into because someone said, hey, notes are cheaper than doing an equity deal, you can do a note deal that turns out to be just as expensive and just as complicated as an equity. The next point is really important. Worse than full ratchet anti-dilution. What is anti-dilution? Anti-dilution says I, the investor, have some right to that if you price the next round of capital at a lower price than I pay, then I get some relief. I get my investment effectively repriced to some extent. So the normal weighted average anti-dilution in a preferred stock investment says we look at the total difference between price A and price B, and we look at the quantity of that dilution, and then we adjust my price a little bit. So I get some value back. Full ratchet says if you ask me to pay $1 a share and then you sell 1 share at 2 pennies, all of my investment gets repriced to 2 pennies. That's horrible. Well, that's exactly what a note is, right? Because the note is the better of a discount against the next price or the cap. That discount against next price means that if the company, even though you expect it to go like this, but in fact it goes like this, like a sine wave, and you hit a low point and that's where you're pricing, all those note investors get the full benefit of that low pricing plus interest plus a discount. That can be exceedingly painful. There's some degree of disalignment, and this happens more than you would think, which is if you get an equity investor today, they want every next investor to pay the highest price possible, right? That's how they reduce their dilution. If you take in a note document or any other kind of convertible where it has yet to price, those same people have a bit of an incentive to make sure that the next price that's set is actually a low price, because that's the quantity of equity that they're getting based on that price. So now you might have kind of your closest investors who might be on your board, who might be part of your advisory team. Those are folks who now have an incentive, an economic incentive to not have the highest price possible be the next round. That can create some tension, and that can be problematic. And again, those interest and discount effects mean that they're consuming value from the moment you do a deal. So an easy way to remember convertible notes is, if you ever agree on what the cap is, and you could have had an equity investor buy in at that same price, you should have done an equity deal. Okay, and I'm going to say that again. If the note investor says, I'm capping the deal at 3 million, and you had an equity investor who said, I would invest at 3 million, you should absolutely do that deal as an equity investment. Because this deal, the note deal, can only get worse. It's going to have interest, it's going to have discounts, and it can only get worse. In fact, if you do the next deal, just because of the discount and interest alone, you would have to do the next deal at, like, call it 3.8 million to get those nice notes to price back to the 3 million you could have gotten in the beginning. And anything under that 3.8 million, your actual price is below 3 million. The thing you used to avoid dilution ended up creating more dilution, right? And you don't see it happening at the time because there's no price attached to it, but that can be hugely damaging. What is a safe? A safe basically looks like a note, except for they've fixed a couple problems. A safe is just a fancy warrant for some amount of equity we have yet to determine. So think of it as I've prepaid the exercise price on my warrant. Here's $1 million. It buys me some amount of equity. I don't know how much. We'll see. It works exactly like a note. We look at the next investment. There's a cap, there's a discount, but the differences are that there's no interest, and most importantly, there's no maturity, meaning there's no chance that the investor can collapse on the asset and snatch it in the way that a debt holder could. So that is much more entrepreneur friendly. It was designed to be more entrepreneur friendly. Some investors will accept that position and some will not. Some investors, particularly if you have a diffuse group, you have a bunch of investors, some investors like safes because, well, they might not collapse on it. These guys might. And so they prefer knowing that nobody can collapse on the asset by being a debt holder. And so where you have a coalition like that, sometimes safes are easier than where you have a single investor who says, nope, I'd rather be in the position of a debt holder for now than a safe holder. We'll talk more about this in a few minutes. So what's happening just as the economy, anytime the economy takes a dive and there's a lot of uncertainty, some big things start happening. And some of this trend actually started happening about 1.5 years ago. And the first one is that the notes and safes started to become a part of the pre-money. So before you try and read that slide while I talk, I'm going to go up for a second so I can prevent you from reading it for a second. I just want you to think about this conceptually as you're listening to this. When you have a note, there are two possibilities about how that note is treated from a value perspective. One is that it's as if those note holders show up at the closing of the future event and say, here's my note. It's like I'm putting cash in today and I'm part of the new money. I'm part of the new investment in the company. And there's some logic to that. And for many, many years, that's how notes were treated. In fact, from I'd say about 2003, 2004, when we started to see notes really start popping up, all the way through about 2-3 years ago, that was how notes mostly happened. They were treated as part of the post money. So I'll just give you an example. Let's imagine the company was worth $7.5 million. We agreed, and there was $500,000 of notes out there, and new investor was putting in $2 million. It was the equivalent of $2.5 million on a $7.5 million pre-money, meaning post money 10 million. New investors represent 20%, the note investors represent 5%, and the pre-existing investors represent 75%. That's how it went for a really long time. And then lots of money started flowing into the system. And anytime lots of money flows into the system, we get the proverbial bubble. And when the bubble happens, part of what that means is prices go up. Those pre-money values start increasing. And one way investors started to decrease their risk, equity investors, is they said, look, you entrepreneur, you've gone out and raised a bunch of notes and you've spent the cash. It's not like the cash is sitting on your balance sheet. When I show up with money, my cash is yet to be spent. This other stuff you have, it's already been spent. So when I told you that the value of the company was $7.5 million, I'm treating it as if the $7.5 million is everything on your side of the table. That includes options, notes, safes. I don't care. That's a your problem. I'm buying in on a post-money basis. And I'm just going to show you a quick scenario. So this is how, if I'm a new investor and I show up, and let me use different numbers just to make it a little bit easier. If I say I'm going to invest $2.5 million on a $7.5 million pre, I expect that I'm going to be 25%. I'm the red in this story. I don't care what's happened before me. So if you have note holders, it's not like the note holders are showing up on top of, they're not part of the red pie, they're coming out of everything else. And so by putting them in the pre-money, it is treating the notes as if they were a standard deduction against the equity value that we had agreed. And this can be a huge problem. We had a deal in which there were almost $6 million in notes outstanding, and there was a disagreement between the entrepreneur and the investment about whether the conversation reflected an enterprise value from which the notes would be deducted, or the conversation represented an equity value. And so when you think about it, let's use examples closer to kind of an early stage company. If you have $1 million of notes and you find an equity investor who says, I'll put money in on a $3 million valuation, I'll put $2 million on $3 million. So they're expecting, right, that they're going to be at 40%. Those notes that may be out there and that may convert at a valuation equivalent to $2 million, that's all coming out of your side of the deal. So you don't own 60% of the deal. You own something much less than 60%. Investors still own 40, but entrepreneur owns maybe 40 also, and the notes may represent 20% of that deal in the notes in the pool. And so that is a big change. And one of the things people often ask is, can we contract out of the problem? Can we and the note investors or the safe investors agree that we'll treat the note and the safes as part of the post and not as part of the pre? And the answer is no. And the reason you can't is because it doesn't matter what your point of view is. This is a condition of the next equity investor, who increasingly are saying, I will only treat outstanding convertible instruments, notes and safes, as part of the pre-money. Doesn't matter that you and the note holder have agreed it'll be in the post. I'm telling you, if you want my money, it's in the pre. And we're seeing this happen more and more. The other thing that happens is, God forbid, you've actually done a preferred stock deal and then you've done a note deal and the preferred stockholders have anti-dilution. When you do this note deal that becomes part of the pre, it's kind of recursive pricing. They used to call these death spiral deals, right? As you deduct money from the valuation representing the notes and the safes, that reduces the pre-money price. The pre-money price, as it reduces, increases the anti-dilution adjustment of the pre-existing stockholders, who then again changes the effective price, and down the rabbit hole we go. And so that can create an enormous amount of dilution for not a lot of new cash. And that's a big problem for people. Let me go back to this slide for a second. Sorry. So how does that contrast with equity, right? Equity is more expensive to document, and investors in theory are buying a known percentage of the business, and that requires you to agree on a valuation, and you have to give control rights, and you have to give up dilution, but you get aligned on next round pricing. There's no default risk. Again, safes also no default risk. And you typically don't have interest effects and you don't have discounting effects. So there's, in a lot of ways, again, if you can get an equity deal at or near the same price of a cap in one of these deals, you should absolutely be doing equity deals and not note deals. So what else is happening because of the crisis, right? If the notes in the pre problem has already started to happen, what else is going on? Well, it is most folks' opinion mine among them, that there's going to be reduced capital supply over the coming months. And so as capital goes out of the system, that's going to cause prices to go down, right? So that's going to reduce pre-money valuations, which is going to create pressure by entrepreneurs to use a convertible instrument to try and, again, extend the bridge to say, well, don't value me at $1 million. That's too dilutive. Let's wait and we'll value me up here. Let's use cash and create value up here. So that's fine if in those notes you have some good protective terms, but if you agree, if there's a pressure, okay, I'm going to use a note so I don't price, but then they give me a cap that's a low cap, and they give me high interest rates, and they put a bunch of control provisions, and it's an expensive thing to document. I've pretty much lost all those reasons to do it, right? I think I've fixed my problem of, ooh, prices are down, I don't want to price low. But in reality, I have priced low and I've created a bunch of additional problems to boot. So that's going to be a problem. The second is that the equity deals themselves are going to start to have worse terms. We expect that investors, as they go into risk management mode and trying to goose returns, they're going to start insisting on much more investor-friendly terms. And we saw this in 2001, we saw this in 2007, where they add multiple liquidation preferences, increased interest or dividends, full ratchet provisions, participation, all these things that say, even if there's a relatively bad outcome for the company, me, the investor, particularly institutional investors investing other people's money, I still get a pretty good return. And where do you can only squeeze the balloon so far. Like, where does that return come from? You, right? It's coming out of the common stock founder and team portion of the value, right? It's coming directly from you. Other things that are going to happen is that, and I don't think I'm telling anybody on this call anything they don't know, but for most categories, there's going to be over time, we think, decreased revenue, decreased velocity. Although for right now, certain, as people go into hunker down, bunker mode, some of the shelf stable categories have actually had their best quarters ever. They've done that by depleting all of their inventory, because one of the corresponding problems is they're having problem building new inventory. They've got supply chain issues. They can't source raw material manufacturing. We have one client who sources, and wait for it, Italy and China, right? Like, it's couldn't be worse from a supply chain perspective. Excuse me. But from a sales perspective, it's flying off the shelf. There's reduced logistics support. So for some of you who are going through Amazon, that's a big problem, or other DTC, you're having real problems. For others of you who are distributing through distributors who are saying, I can't get drivers, I can't get trucks, things are, it's really, really difficult right now to deliver. So you're out of stock on all kinds of shelves. We expect, although it has not come home yet, I think I see Bob Craig on the call. Bob, is that you? Right? Bob is at Centerman Capital and the Power Play Fund. And if you want to ask your outsourced CFO what their current thinking is on whether receivables are going to start to get slow paid, meaning people who used to pay you regularly, in 20 days, maybe they use the full 30, decide, well, they're going to pay you in 45 or 60 days. And, so what? What are you going to do? You're going to stop doing business with them? You're going to sue them for the 15 days? No, they're just going to slow pay you. And if they're in cash crunch mode, you should absolutely respect that. And even worse, an impaired receivable where it's never going to get paid. They're potentially facing insolvency. So for those of you who are distributing, particularly to a lot of retail, consumption on premise, a lot of these restaurants, you could have thousands, tens of thousands, hundreds of thousands of dollars in inventory delivered for which you're never going to get paid. They're going to go bankrupt. And that's very scary. Excuse me. There's going to be, we think, some reduced borrowing capacity at the traditional lenders under traditional programs. And there's absolutely going to be a reduction in the ability to conduct in-store marketing programs. So all the demo stuff is dead probably for the next 6 months, right? Like even if you could do it, the question is any random human going to take food from a stranger in a Costco for the next 6 months? Wouldn't bet on it. So that's going to really start to really hurt revenue and margins and operating stability, all these things. So one way we talk about that is your runway just got way shorter, right? That means that the cash that you've already raised and that you were hoarding to try and grow probably is not going to last you as long as you think. And that leads to the next wonderful slide. That's when do you hit the brick wall, right? When do you run out of cash? And what do you want to do about that? And, you know, we tend to think about the world as over the last 7 years in particular as, well, the answer to that is I'll go raise more capital. I'll create a bigger war chest, and that'd be nice. But if capital supply becomes constrained, what do you do? And how do you attract that capital? And so we think that one of the ways you're going to be able to successfully close investors is to say, not only am I raising money from you, but I'm doing some other things. I'm going into immediate burn reduction. Any of you CEOs who have been historically paying yourself 6-digit fees in compensation, I would expect every investor out there to start saying things like, if you own more than 50% of the equity, I expect you to be at or near minimum livable conditions, right? 60 grand, 70 grand in comp for people who were previously taking maybe 120 to 200 out of a business. I would expect people to require immediate burn reduction, both from existing investors in your company, but also from many prospective investors. I think they're going to start to ask you questions about slower growth and slower burn strategies. So instead of, we're going to spend $3 million in marketing capital to grow the top line at the expense of the bottom, it's going to look more like a traditional Main Street business. How do we get to cash flow break even faster? Even if that means slower growth, even if that means that the early money is not going to lead to venture money on the back end, because venture money has to grow at extreme high growth. Think of it as multiple hundreds of % a year to validate a venture model. And you may find early investors now who say, I will give you a bridge, but I don't expect we're going to go raise $5 million in venture financing in 9 months. That's probably unrealistic. Why don't we craft a model that says maybe we go raise $1 million and we do many fewer things than all the things you were envisioning in your head and that people have done over the last 7 to 10 years to build high growth businesses. For those of you who are not DTC, you're not already on Amazon or similar platforms of getting into DTC where you can create more cash flow. Even if you can't do, even if that cash flow is not valued as highly by investors and acquirers, that it still is helping to float the company and to provide stability against really fluctuating retail environments. We think investors are going to require you to sign up to any of the available economic development programs. For those of you in nationwide PPP and EIDL, but in Massachusetts and every state is starting to roll out, a Main Street program that's designed to be the state supplement to CARES Act debt relief, to trying to provide money for payroll, money for infrastructure. For any of you who have your own manufacturing facilities, I guarantee you there's going to be more money flowing into trying support manufacturing jobs over the coming months. So looking into those programs, and if nothing else, having a story to tell an investor, hey, we looked at programs 1 through 7, here's what we ultimately decided to apply for and why. As opposed to sitting in a meeting and someone says, hey, did you do triple P? And going, what's triple P? Or no, we didn't apply, we didn't get there in time. Like, none of that is going to be good news for you as you're competing for that capital with other entrepreneurs who are more organized in their approach. And the other is accelerating timing. What that means is, again, while people were thinking about bridging, I'm going to take a little bit of money here to try and create a lot of value so I reduce my dilution by the time I take big money here. The answer is nope. Take all the money you can right now and accumulate that war chest, because we have no certainty about what is going to be available from an equity investment program over the coming months. And I was on a program yesterday and a couple of days ago as well, where we talked about that the capital supply from individual angels we think is going to get compromised, from angel groups is going to get compromised. Early stage venture who are in the latter part of their funds are probably going to move money from new investments into existing investments. And we worry that some of the investors who you were counting on to put money in through their next fund may be unable to raise those next funds. So every dollar that you can accumulate right now at the war chest acts as insurance against this big set of unknowns about what's going to happen over the next 3, 6, 9, 12 months, where we really don't have insight into how things are going to play out. So that's the heart of the presentation. I'm sure people have questions, so I'll take a breath, drink some coffee, If I don't know if Annie's on the phone, but you're the lucky winner of the free advertising, and we'll go from there.
Great, thank you, Jeremy. So at this time, we'll take questions. We can have people please raise your hand using the raise your hand function. We'll call on you. Or if you'd like to submit your question through the chat, we can take that and ask Jeremy at this time. Jeremy, one question that did come in over the course of the presentation was, does convertible debt have to come from an accredited investor?
It's a great question. Thank you, whoever asked that. So any investment into your company that is, quote, a security, and a security is, think of it as any form of investment, whether debt or equity, that looks or smells like it might eventually be equity, does have to comply with both state and federal securities laws. And the best way that you can create flexibility for your company going forward is only to ever take money from accredited investors. There are ways to accept money from unaccrediteds. It requires you to comply with different rules and can create real problems for you going forward as you're asking existing investors for additional capital in later rounds. So we really stress, even when it comes to friends and family, if at all possible, do not take money from unaccredited investors. And what some folks have done is utilize things like the old Jobs Act crowdsource platforms that are aggregating people in permitted ways. But most brands have raised money in the more traditional 506B methodology of private capital coming in, not through a platform. And again, notes, safes, equity, options, warrants, doesn't matter what you call it, still have to comply with the securities laws, and still would recommend that everybody be accredited.
Okay, great. So Paul, you are unmuted, and please feel free to ask your question.
Hi, everyone. Jeremy, can you hear me?
Yes.
Okay, fantastic. Great to see you. Thank you for doing this. Very quickly, very specifically on how terms are changing in this environment. There's one in particular that I've seen, but I wanted to hear if there's other things that you've seen and maybe strategies to push back if you're willing to do so. One is that investors are looking at the founders to put in capital alongside the investor as well. That's one thing that has come up recently. What other things are you seeing, and then do you have any strategies then to push back?
Sure. I would say my experience is that it's less that people want you to put in cash than they want you to be at risk. So you need to have contributed something that is very near and dear to you that you do not want to lose through inaction or negligence, right? And that can be, if your market value to go get a job at some place is that you would normally make $250,000 a year, and instead you're working for the startup for 40 grand, you are at risk, right? Yeah. If on the other hand, you've been paying yourself $240,000 a year, plus a bunch of equity, plus you've got, your car under the company's name and blah, blah, blah. Like a lot of times investors feel like you are not at risk and you are just as happy to walk away from this thing as you are to stay. And that makes them very nervous. They don't like that at all. They want to make sure that your incentives are aligned with theirs, because what they're betting on early on in these companies is really you. Most of you don't have any appreciable intellectual property, and most of you don't have a lot of appreciable technology. And there's not even a lot of systems and infrastructure. So what they're really betting on is you. And if they don't believe that you are fully motivated, then you have a real problem. In later stage deals where the team is the less critical piece, there's infrastructure, there's customer loyalty, there's a brand with brand value. That may be less true, but at the early stages, they are betting on the jockey. And so how would you push back? You would push back by saying, let me show you how I am invested. I don't happen to have a ton of liquid capital, but I've put every other thing I own in life, I have into the business. I will say another way to push back is no investor wants you distracted. And so if you have done terrible things like take out home equity lines that you think you now can't pay because they're saying, well, we want you to work for no salary, right? then what a lot of people will say is, look, if I have to have a conversation with my significant other every day about why we can't pay the mortgage, I am not going to be focused on the business. P.S. If they stab me in my sleep, I'm definitely not going to be focused on the business. So, I need to earn enough to be focused, and I need to, you don't want me so at risk that the at-risk thing becomes its own impediment. Right. And people are in different places. Some people come to entrepreneurship having substantial personal means or spousal income, and others do not. And so it's going to be particular to every team and every business.
Great. Thank you very much.
So another question we got through the chat here, Jeremy, if a founder is capitalizing the entire company's operations at present and puts together a note so that they will be repaid for their out-of-pocket expenditures for bankrolling the company's payroll and expenses, would that note likely dilute the founder's shares of equity at the time of the initial financing, whether it's equity or a convertible note?
Okay. So there is no real, well, not no downside, but there are few downsides to documenting your investment as a note, your contributions into the company as a note. Except here's what typically happens. I'm going to go back. Can you guys all see this slide, or do you have the chat function up? Hopefully it isn't overlaying it too far, but they're going to go back to saying, I don't care how you have denominated your investment. I am going to treat all of your investments, whether you've listed it as a note, a payable on the company's books, like a short-term loan, or equity, all as contributions to capital, all as part of your equity investment. And I'm going to wipe out anything that looks like you're going to take money back out of the company when I put money into it, right? I, the investor, am not going to stick money in so that you can pull it back out and repay yourself. That is almost universal. What occasionally entrepreneurs are trying to accomplish is to say, well, I put in money relatively recently. Now you're coming in. Why should my cash be worth less than your cash in terms of what it buys from a rights and preferences perspective? So I'll do it as a note so that this next tranche of money I've put in becomes preferred stock as opposed to common stock, right? That's just part of my tax basis in my common stock. That sometimes works, usually doesn't, but does sometimes work. And it's usually about how recent was that contribution. If you put in money 2 years ago that you denominated as a convertible note, it is almost never the case that they're going to let you convert that note into preferred stock. Again, they're going to wipe it out and treat it as a contribution to capital that increases your tax basis in your existing common stock. Other things that founders occasionally do is say things like, I'm going to create an IP holding company and license myself. Company A is going to license company B the recipe, the trademark, the whatever. Investors will wipe that out too, and that really actually aggravates them. It annoys them substantially. I don't recommend that. Founders who issue themselves preferred stock before getting investors, you have just shown a level of kind of unsophistication that has damaged your credibility. Don't even bother to do that. There are things called founder shares that occasionally, and that's not a technical term, but people sometimes refer to it as founder shares, or they'll say things like their Zuckerberg shares. And the idea is you're trying to create a difference between the shares issued to the founders versus the common shares issuable to employees. That does have its place. There are some tax advantages that you can avail yourself of if you do those things, but it doesn't usually fix any of this stuff in terms of the money coming in being treated as an offtake. Again, the one lone exception is if you have really gone out on a limb, you took money out on the house, you took money out of the 401k, out of the kids' college fund to do a thing, and you really were counting on putting that money back in. Sometimes investors will have a small bit of mercy upon you and let you take a little bit back out. But again, that's going to reduce the price of the deal. So you're not going to get someone to say your deal is worth $3 million and you're taking $100,000 out. They're going to say, okay, well, your deal is now $2.9 million. And you're taking $100,000 out. And again, even that is very, very rare at early stage. Very, very rare. Does that, I'm not sure if that fully answered the question.
Great. We don't have any further follow-up, but if that comes through, I'll let you know, Jeremy. Another question that came in, can you talk a little bit about founder sales bonus at exit to capture the founder's initial investment?
Again, usually the kind of thing that would get wiped out. People will say, nope, you're just in the common stock. There is a bit of an exception here. I had the fun of working with Seth Goldman and Barry Nailbuff of Honest Tea, who are somewhat famous for kind of flipping the usual risk profile on its head. And it's not tax efficient other than in an LLC for anybody to do this. In a corporation, this doesn't work out well from a tax perspective, but what some folks have done is say, I will accept your low price investor. I'll do it as an equity deal, not going to do it as a debt deal. But if the company performs over certain benchmarks, the company is required to give me back equity in the form of options, and me being the founding team, whether that's one person or two people or whatever. And so if the company goes like this, I get a slug of options, and when it hits here, I get a slug of options. And that can reduce it inverts the dilution to say, okay, I went from owning 100% to owning 60%, but now I'm back to owning 65 or 70% because of these option tranches. The option tranches are much less tax efficient. So on a net tax basis, that's not that friendly, but it is something that people can do. There is the concept of employee bonus pools that happen at exit, but it's usually not for the founders. And again, the only time you would typically do this is as a compromise where you and the investor really can't agree about what the pricing is. And so you're trying to say, well, we're going to performance adjust the valuation based on what actually happened. That can be very risky. That adjustment often gets instituted both ways. And more deals don't hit their benchmarks than hit their benchmarks. So you're taking a risk that the price that you just agreed to can get even worse from your perspective. So that can be very painful. But most often investors will say, I'm not going to put you in a debt position, which is what a transaction bonus is. It is paid before the preferred stock. I'm not going to put you in a debt position above me at exit just so we can, get to a particularized price, kind of a notional price. It can happen in certain kind of deals. And again, in LLCs, you can create a little bit more flexibility around this stuff. It's a little bit easier to create things like IRR hurdles and a lot more complexity. But in early stage, you don't want to spend $250,000 on legal fees to document $1 million deal. So vanilla is your friend, and all of this complexity we're kind of hinting at is not something that I would recommend for most folks.
One comment on that, Jeremy. One of our attendees is reflecting, it feels like the cap on a note is almost a de facto price. Would that be correct?
Sure is, right? The cap on the note is, think of that as the best deal you can get, but it could get a lot worse for you. And in fact, many, many deals, the notes are not converted at the cap. And to remind people, because it is in almost every note, the better of the discount or the cap, if I do a deal at 3 million, I'm just reminding you, right? If we say cap 3 million, it's not that if I do a deal at 3 million, these guys price at 3 million. If I do a deal at 3 million and they have a 20% cap, these guys are pricing at 2.4 million. They're getting 80% of 3. So in order to even get them to pay the cap price, I need to do a deal, right? That is, whatever that is, 1 over the discount price times that cap. I need to get 25% above it in order to get back down after the discount to the very cap that I thought they were going to pay. So that goes back to, if you could get those same investors to do an equity deal at 3 million versus a cap at 3 million, you should always do the equity deal. It's only where the cap is relatively high, where the investor says, I would come in at 3 million, I'll give you a cap of 5 million, that the note makes sense because you're trying to capture that $2 million of value in terms of the reduction to dilution. That's where it does make sense. If they say, nope, I'll do 3 million or a cap of 3 million, please do the equity deal, because all you're doing is giving away interest and discount on the note, plus the possibility that that note could turn into, priced at 2 million or 1 million.
Great. Any further questions? Please feel free to send them to me via chat or raise your hand and we can unmute you so that you can ask Jeremy directly. Okay. Well, if there are no other questions at this time, Jeremy, we want to thank you so much for your time and preparation and preparing this deck. Always great to co-host these things in collaboration with Nutter and get your great expertise on paths forward as it relates to financing and particularly how to think through these challenging times for entrepreneurs and in growing their businesses.
It's our pleasure. Just a couple of things for everybody. If you have questions about Triple P or other COVID-related matters, please check out the Nutter webpage. We have a link right from our homepage, nutter.com, N-U-T-T-E-R, nutter.com, that has resources for entrepreneurs. So please check that out. It's got a bunch of materials there that are really worth checking out. Second, whether you work with Nutter or you work with somebody else, please work with sophisticated counsel who understands not only early stage entrepreneurship and high growth businesses, but who understands food and beverage, because people, tech deals are not the same as food deals. People do different things and there are different concerns in those deals. So really try and find, people to work with both on the accounting and the legal side who understand your industry and who understand your stage and the velocity of these kinds of companies. That is my plea for you. We spend a lot of client dollars and time fixing things that could have been done much more efficiently and correctly at the beginning. So please do, get great help if you really believe in the value of the asset. Don't skimp on getting the right kind of help.
Great. So as a quick reminder to everyone, this presentation will be available on our YouTube page and I believe on Nutter's website as well. All further information on our upcoming series with Serving Up Support can be found at branchfood.com/servingupsupport, which is also where we will link to the recording of this presentation. So for those of you that'd like to review again, please do so there. And then any further feedback for Branchfood, or if you'd like us to connect you directly with the team at Nutter, you can reach us at info@branchfood.com. But I also put Jeremy's information, direct contact email and phone number in the chat for everyone to reference going forward. Jeremy, will this presentation be available? We'll share the recording, but can we share the deck?
Absolutely. I'll send it to you in a PDF that everybody can have. And we've got some articles on some of this stuff that are out there as well. And we'll be publishing another one on notes as well in the next week or two. So stay tuned.
Great. Great. Thanks for making that available. And we look forward to seeing you all hopefully soon in person, but in the meantime, virtually more likely. Thanks again, everyone, and enjoy your weekends.
All right, bye, everyone.